Every field has its foundational texts, those definitive guides that, shape generations.
Hmm.
But in the world of investing, which can be pretty turbulent, sometimes chaotic, finding a guide like that, one that truly lasts.
It's incredibly rare and powerful when you find it.
Exactly. So today we're doing a deep dive into one of those rare gems, Benjamin Graham's classic, The Intelligent Investor, first published, get this, way back in 1949.
That's right, 1949. And our goal here, it isn't just to, review an old book.
No.
We're trying to pull out the core principles, the actionable stuff from the detailed review you mentioned, principles that, well, they've stood the test of time.
And shaped some huge names, right?
Yeah.
Like Warren Buffett, he famously called it, what was it?
By far the best book on investing ever written. High praise.
Can't get much higher than that. So for you listening, maybe you're prepping for a meeting or just trying to get up to speed on finance.
Or maybe you're just curious.
Right. This deep dive, it's meant to be your shortcut to get that enduring wisdom that helps cut through all the market noise and speculation, get some real clarity.
Okay, so let's unpack The Intelligent Investor. We really have to start with the architect himself, Benjamin Graham.
The father of value investing.
That's him. And maybe most famously, Warren Buffett's mentor. That connection alone says a lot.
It really does. But what about the book itself? How has it stayed relevant since 1949? That's over 75 years.
Well, what's interesting is how it's evolved. Later editions have commentary by the financial journalist Jason Zweig,
Ah, yes.
and his editions are brilliant. They kind of bridge the gap, making Graham's ideas feel fresh and applicable even today. Shows how timeless the core concepts are.
And that Buffett endorsement, it wasn't just a throwaway comment, was it? He really credits it as the foundation for how he invests.
Absolutely. Buffett said Graham gave him the intellectual framework, the structure to avoid big mistakes, and crucially, stay emotionally stable.
Emotional stability in investing, that's huge.
It is. Graham offered this illogical, disciplined path. It was like the opposite of all the speculation and fads. And that discipline, that's really Graham's core message.
So intelligent investing isn't about hitting home runs or timing the market perfectly.
Not at all, according to Graham. It's about rational decisions, thinking long-term, being disciplined. Really, it boils down to buying assets for less than they're intrinsically worth.
Okay, intrinsic value, that's a key term. For listeners maybe newer to this, how did Graham think about figuring that out? What is intrinsic value?
So Graham saw intrinsic value as like the real underlying worth of a business based on its assets, its earnings, dividends, future prospects, stuff you find through careful analysis.
So it's separate from the daily stock price swings.
Exactly. Independent of Mr. Market's moods, as we'll get to. And this idea leads straight into maybe his most critical concept, the margin of safety.
Margin of safety. This feels like where Graham really diverges from a lot of other approaches. It's more than just a cushion, isn't it? What does it do for an investor, psychologically?
Oh, it's massive. Think about it like this. Say your analysis shows a company is intrinsically worth $100 a share.
Correct.
Graham would say maybe buy it only if it hits, say, $70. That $30 difference. That's your margin of safety.
Got it. A buffer.
Exactly. A buffer against being wrong or against unexpected bad news or just market craziness. Psychologically, it means you're not sweating every little price dip because you bought it cheap. It reduces risk and therefore reduces anxiety.
That makes a lot of sense. So you understand value, you understand safety. Then Graham says you need to understand yourself, your role. He draws a really sharp line between investors and speculators.
He does. For Graham, an investor is someone who analyzes thoroughly. They prioritize, first, safety of their capital, and second, an adequate return. Long-term focused, conservative, really.
They're buying a piece of a business.
Precisely. They care about the business behind the stock ticker.
And then there's the speculators. How did he define them?
He saw speculators as basically gambling, betting on short-term price moves, chasing quick profits, often without really understanding the underlying company.
And that distinction feels, well, maybe even more important today, doesn't it?
Oh, yeah.
With meme stocks and crypto frenzy. Lots of people acting like speculators but calling themselves investors.
Absolutely. It's easy to get caught up, and that kind of behavior is exactly why Graham introduced another one of his most famous ideas, the Mr. Market analogy.
Ah, Mr. Market. Everyone loves this one. Explain him.
Okay, so imagine the stock market is your business partner. His name is Mr. Market.
Okay.
And every single day, he comes to you and offers to either buy your share of the business or sell you his share. The catch is, Mr. Market is, well, he's moody.
Manic depressive almost.
You could say that. Some days he's wildly optimistic, quoting a ridiculously high price. Other days he's utterly convinced the sky is falling and offers you a super low price.
So the key isn't to follow his mood swings.
Exactly. That's the genius of it. Graham says the intelligent investor shouldn't get swayed by Mr. Market's irrationality. Instead, you use it.
Use it how?
You see his pessimism, those lowball offers, as buying opportunities, and his crazy optimism, those high prices, maybe as chances to sell. You rely on your own judgment of value, not his emotional state.
It demands real psychological discipline, though, to go against the crowd like that.
It does. Resisting the herd is hard. But Graham believed that was the investor's job. Use reason, not emotion. Use market fluctuations to your advantage.
Powerful stuff. And Graham knew not everyone invests the same way, right? He didn't just offer one path. He talked about different types of investors.
That's right. He outlined two main archetypes. First, the defensive or passive investor.
Okay, what's their approach?
The defensive investor focuses on safety, simplicity, minimal effort, think diversification, large, stable companies, or even easier, index funds or ETFs, just buying the whole market, essentially.
Low maintenance, steady Eddie kind of approach.
Pretty much. Reliable growth without needing to become a stock-picking expert.
In the other type.
The enterprising or active investor. This is someone willing to put in the work. Significant research, real effort.
What are they looking for?
They're trying to find those undervalued gems the market missed. Maybe smaller companies, special situations, things that require digging deeper. It's definitely more demanding, needs time, and frankly, the right temperament.
So he provides strategies for both paths, acknowledging different people have different goals and, well, different amounts of time to commit.
Exactly. It's not one size fits all.
Okay, so let's try and boil this down. If we pull all these core ideas together, what are the big lessons for you, the listener? We've got 5 key takeaways. First one seems huge. Avoid emotional investing.
Absolutely critical. Panic selling when the market drops or getting swept up in euphoria during a bubble. Graham says that's how wealth gets destroyed. Keep your cool.
Second, stick to that margin of safety.
Always. It's your bedrock principle for cutting risk. Your buffer against the unknown.
Third, don't try to time the market.
Forget the crystal ball. Graham preached patience, discipline. Trying to predict short-term ligs and zags is mostly a losing game.
Fourth, understand what you actually own.
Yes. Buy a stock like you're buying a part of a real business, not just a blinking light on a screen. Ask yourself, would I be happy owning this if the market shut down for 5 years?
That's a great test. And finally, fifth, market volatility is your friend.
Embrace it. Don't fear the fluctuations and see Mr. Market's crazy prices as opportunities to buy low, not reasons to freak out.
Okay, so those are powerful principles. But let's tackle the elephant in the room. It's 2025. Is a book from 1949, even with updates, still truly relevant?
That's a fair question. And let's be honest, the original Graham text, it can be dense, academic almost.
Yeah, I've heard that. Uses examples from the 50s. Maybe not the easiest beach read.
Definitely not. It's not a get-rich-quick book or a hot stock list. It's really a guide to developing an investing mindset. You need some motivation to get through it, especially as a beginner.
But despite the density, the core wisdom, you'd say it holds up.
Absolutely. The framework, the principles, value, discipline, margin of safety, they are timeless. And as we said, Zweig's commentary really helps connect the dots to today.
How does it connect specifically to markets right now in 2025?
Well, think about how fast things move now. How much data, how much noise, how much speculation there is. Crypto, meme stocks, constant news cycles.
It's overwhelming.
Exactly. And Graham's focus on fundamentals, on rationality, on that margin of safety, it provides an essential anchor, a way to stay grounded amidst the chaos. His ideas on defensive investing even line up perfectly with how popular index funds and ETFs are now.
So it's kind of an antidote to the hype.
A very powerful one, yes.
So who should actually read it then? Who is it really for?
I'd say serious investors, people committed to building long-term wealth, finance students, definitely. Anyone who wants that foundational understanding.
And who maybe shouldn't start here.
Probably day traders, people looking for quick flips, maybe crypto-only folks, unless they want the broader investing philosophy. And impatient beginners might find it tough going initially.
Okay, so summing up, The Intelligent Investor. It's not about what stocks to pick.
No, it's about how to think about investing. It's a financial education and mindset, really, one that can genuinely serve you for a lifetime.
And even though Bart's might feel a bit dated, You argue the core wisdom is maybe more needed now than ever, given how noisy and speculative today's markets can be.
I really believe that. The discipline it teaches is invaluable.
So we'll leave you, the listener, with this thought. How can you take these timeless principles, that idea of a margin of safety, or learning to see Mr. Market as an opportunity, not a threat? How can you apply them to navigate the sheer flood of information and, let's face it, speculation in your own financial life?